Hello and welcome to Ask You for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Wall Street seeing green. Stocks hitting fresh records on Tuesday. Investors like what they're hearing in earnings reports and are getting ready for the Fed's big announcement Wednesday. At the end of the session, all major indices did end the day higher. And American business may be ripe for marriage right now across diverse sectors. We're taking a deep dive into the state of play of mergers and acquisitions. And millions of Americans are days away from losing food aid in the form of SNAP benefits, but they may not be the only population that feels the brunt of those cuts. We're speaking with an expert about that looming deadline. Well, Skyworks Solutions and Qorvo among the latest to announce a deal looking to form a $22 billion combined company. But beneath the surface of the deal-making boom, there is some caution to be aware of. EY America's Vice Chair, Mitch Berlin, joins us now to discuss. Mitch, it's good to see you. So let's start with 2025, Mitch. As we head into year end here, what is the state of deal-making? How would you characterize it? Volume, value, what do we see?
I would say the first half of 2025 was a little bit up and down, a little bit like the Swiss Alps, but Q3 really showed a return of the M&A market. So overall deal volume is up about 9% year over year, and deal value is up about 36% year over year.
What would you say explains that uptick?
I think it's about confidence. I think there's moderated confidence back in the M&A market. The capital markets are strong. I think the S&P 500 will end this year at its highest since 2009, so the capital markets are strong. There's confidence in the cost of capital coming down probably over the next 12 months, 100 basis points down. I think that the regulatory bodies are more M&A friendly than they had been in the past administration. And I think then that's tempered a little bit by the rising unemployment rate and a little bit around moderate GDP growth over the next 2 years, about 2% over the next 2 years.
This year, Mitch, where are the sectors where you've seen the activity?
Technology for sure. About a third of the deals are in technology, followed by oil and gas and then life sciences.
And so let's look ahead, because your deal barometer, Mitch, it looks like it's suggesting your rising deal volumes through 2026. What is driving that?
It's, again, moderated confidence. So I think people are comfortable putting deals in front of the board now where they hadn't been in the past, all because of the things that we mentioned before. Again, the capital markets are strong, cost of capital is coming down. There is confidence that the boards will approve deals now where they hadn't in the past. If you just look at tax-free spins, tax-free spins were at an all-time high in 2021, then they crashed. There have been about 6 big tax-free spins a year for the past 4 to 5 years. This year, we're probably going to end the year at about 12 to 14 significant tax-free spins compared to about 6 or 7 last year. So boards are getting more comfortable doing big deals because they're comfortable in the markets and they're comfortable that they're going to get the valuations that they want. Also, the bid-ask gap is narrowing. So there in the past there was a big gap between what the sellers are willing to sell and the buyers are willing to pay.
Why is that narrowing? That's interesting.
It's narrowing because I think I think people are getting more practical around what their deals are worth. First of all, if you look at private equity, they've been sitting on assets for a long time. Mm-hmm. Typically 3 to 5 years is what the holding period. They've been sitting on them longer. They have to move them. They're sitting on a lot of dry powder. They want more money. They have to get those out. So they're coming down on what they're willing to sell those for. And the cost of capital is coming down and expected to come down more, so they can afford to pay more for that. And so that's narrowing that bid-ask gap.
At the same time, you have these potential tailwinds, Mitch. You also have these big open policy questions still. You get trade and tariffs. Next year, you're going to have election year politics front and center. How does that all potentially impact how CEOs and CFOs are thinking about deal making?
I think people are building volatility into the valuations. Every CEO has a contingency plan for what can happen around the tariffs, and they're building that volatility into the valuations that they're pricing those deals at.
How much of what we're talking about here and your outlook depends on the Fed and the rate cut path?
I think people are pretty comfortable that they're going to see about 100 basis points in the next 12 months, and that has been built into their cost of capital and what they're willing to pay for those deals.
As you look ahead, Mitch, next year, where would you expect to see the deal-making activity? Would it be the same as 2025? Would you see some
It's going to be lower. I think it'll be about 3% in increase year over year, maybe 3 to 4%. More in private equity. I think private equity has a lot more to do. So we'll probably see 3% in corporate, about 5% in private equity.
And in sectors, would it be tech still?
Tech for the foreseeable future.
Why do you say that, foreseeable future?
Because there's so much going on. There's tech for tech and non-tech buying tech. So tech, there's so much activity going in AI and consolidation around cloud and infrastructure. And then there's non-tech buying tech. You see a lot of life sciences companies buying tech companies, a lot of retail and consumer buying tech. Everyone's buying tech companies. So tech is always going to be a target.
Speaking of tech, what about that mega AI trade and trend we talk so much about? How much is that driving deal making?
AI is at the forefront of all tech deals.
Let me ask you finally, FTC Commissioner Andrew Ferguson, what do you make so far of how he's done? How would you rate him?
It's not something I follow that closely to really give a formal.
Let me ask you a broader question. The regulatory landscape, how has it shifted? How's it changed?
You know, it's an interesting question because I think when the new administration came in, they thought the FTC and DOJ were going to be much more deal friendly. I think they're not killing deals, but they're not as deal friendly as we expected probably going into this administration.
How do you sort of navigate that if you're a CEO?
I think overall, I think the capital markets, the cost of capital, all the things that we mentioned earlier around a friendly economy are making the deal environment better. And I think that is what's promoting the strong deal market. I think that the regulatory body is what the regulatory body is, and you just have to move forward.
Mitch, great to see you. Thank you, sir.
Thanks, Josh.
Well, the Dow, the S&P 500, NASDAQ notching fresh records ahead of the Fed's rate decision this week. And Yahoo Finance's Jared Blikre joining us now with the trading day takeaways. Jared.
We got to start with the kahuna, NVIDIA, nearing $5 trillion. Josh, do you like magic?
Sure do.
I got a magic trick for you. I'm going to show you the Wi-Fi Interactive. I usually just show you percentage return. There we see NVIDIA up 4.98% today, but watch this. This is the market cap of that company. 4.894, it's about 10 billion away from 5 trillion. And look at Microsoft, over 4. Apple is right there. Another record high for Apple today, by the way. In fact, we had 4 intraday record highs in the Mag 7. So this was really a Mag 7 day. Even Alphabet, which closed underwater today, that hit a record high. But really the story has been chip stocks. I'm going to change this back to percentages and just kind of show you what went on in semiconductors today. As I pointed out at the closing bell, you've got these 3 big names solidly in the green, a couple others here, but a lot more red than green over here. And so that just kind of leads me to the theme of the day.
That's what I want to ask you. Was there a trend, so to speak?
Yes.
Price action.
And the trend is big beats small. Big is better than, or big is greater than small. And that's kind of an obvious tautology, but there's actually some market action that we can see it playing out in. So I'm going to show you the S&P 500, the traditional market cap one, which is weighted one, which is in purple here, and you can see it's up 17% this year. Then we have the equal weighted. That's where each stock gets 1 vote. So NVIDIA gets as much as, your favorite paint stock. And you can see there's a big divergence that has emerged here, and we have just not seen the broad participation in the market each one of these days. We've seen it some days. Yesterday was a very broad participation heavy day, but really over the net balance over the last 6 weeks or so, we've seen this widening gulf. And so that just points to the fact that we have a more concentrated market. And some of the winners, well, they tend to be some of the bigger ones. And that's why you're seeing the major averages up on a day like today. And meanwhile, you take a look at the Russell 2000, final point in this little segment here, Russell 2000 was down 0.5%, and so was the S&P 600. So how you slice it and dice it, I guess it matters if you're big, but you really do wonder what happens if some of those bigger names falter.
What about gold? Another down day, is that party over?
Let me get to the headline first, because gold did crack 4,000, and excuse me, I'm not sure what's happening here. Let's see if we can get, there we go.
There we go.
Gold cracks 4,000, just like I said. We got to take a look at the metal space, because gold was reaching all-time highs day after day for weeks on end, and then all of a sudden all the metal complex just kind of crashed. So this is what happened today. Let me just show you what happened over the prior month. And here, let's see, palladium still up 12.7%. Let's start with palladium, because this is something that was sky high. Here's year to date, and it is down significantly. Now, in the grand scheme of things, you might say, well, that just looks like a blip, but these are heavily leveraged futures contracts, and that's no small potatoes. Here's gold. You can see this is just looks like a little blip. So the long-term trend is intact, but there is some concerning stories I've heard about central banks not being as heavily invested or wanting to buy as much as they used to. Central banks are the reason that we've seen gold surge so much over the last 10 years. Since 2015, up 237%. You've seen China, you've seen Russia, they get the headlines, but you know who the number one buyer of gold last year? It was Poland. And so central banks all around the world have been piling in to de-dollarize. If that trend goes away, well, guess what? That is the biggest marginal buyer. Now, separately, we do have this ETF-induced speculative mania, also people buying the physical, and that's when you see the shorter term trend. This right here, this kind of move, that parabolic move, that is not sustainable. We can see that resume, but you have to have the ETF buyers still be interested, because some of them are getting burned right now. You have to have the people in the futures who are getting margin calls, they have to buy again. And then the central banks kind of backstopping the whole market, you really need them to participate. The problem is you don't really get that much news. Central banks buy kind of under the radar, and it takes a long time for their holdings to be reported and generally well known.
Speaking of central banks,
yes.
Fed on deck tomorrow. What's on your radar? What are you listening for?
You know, I'm really, so I think there's going to be some interesting things about quantitative tightening, and that's the balance sheet runoff, and it's really in the weeds, wonky stuff. I don't think it matters that much, but what I'm watching is the 13-week T-bill yield. And why the 13-week instead of the 10-year, whatever? 13 weeks is only a few months, 3 months, and that's what really closely ties to the Fed's preferred benchmark rate. That is the Fed funds rate. The Fed funds rate is above 4% right now. In fact, they have a target range of 4 to 4.25%. So this is already front-running not only a rate cut, because that would bring the range down to 3.75 to 4%, but it's now below that. So rate cuts are getting priced into the actual market here. We're not even talking about derivatives and the way we usually talk about rate cuts getting priced in. And so my one concern here would be if the Fed is behind the 8 ball and we're seeing these rate cuts because the Fed is trying to catch up and prevent a recession, well, then it's usually too late. So that's what the market is dealing with right now. Economy is kind of on the razor's edge. And by the way, we don't really have the data to know how good or bad the labor market is. So this I find not necessarily good news. Fed cuts are not always necessarily good news. I guess that's my bottom line there.
Thank you, buddy.
All right.
Appreciate it. Stick around. Much more Ask for Trends still to come. As the government shutdown drags on, a new deadline is now front and center, November 1st. That's when funding for SNAP benefits, the Supplemental Nutrition Assistance Program, could run dry if Congress doesn't act. Millions of people rely on those benefits, and the economic ripple effects could spiral far beyond. Our next guest is Kate Bauer, University of Michigan Associate Professor of Nutritional Sciences, School of Public Health. Kate, it is good to have you. So November 1st obviously is quickly approaching here, Kate. Regarding SNAP benefits, can you help us understand what would happen exactly there? Just mechanically, Kate, does that mean, SNAP cards stop working? I mean, how quickly would folks feel the impact?
Yeah. So October benefits on participants' EBT cards have already been loaded. And many of them have run out of those benefits already because they don't cover all of people's grocery needs. But if people do have benefits still on their card, they should still work. What this means, though, this freeze on benefits, is that no new benefits will be loaded for November. And so that means here in Michigan, an average of $335 lost by SNAP participating families, and nationwide, about $8 billion of benefits lost that will not be used to purchase food, will not be used to feed children, and won't be used to support our food retailers.
So that's the number. How many people could be impacted nationally, Kate?
Yeah, so 42 million Americans participate in the SNAP program. That's about 12%, or 1 in 8 or 9 of us who rely on SNAP benefits.
And who receives those SNAP benefits, Kate? What is What's the average demo? What's the profile?
Yeah. So SNAP benefits go to low-income individuals or families. The majority of them are either seniors or families with children. Unlike the common sentiment about SNAP participants, those who are able-bodied must work to continue to receive SNAP benefits. And individuals who happen to not be working and receive benefits maybe have a disability, are caring for a disabled child. These are hard-working families. These are millions of children across the country who need this program to have sufficient amounts of resources for food and won't have that in November.
So that's I wanted to ask about that, Kate, because you are a professor of nutritional sciences, and so I was curious how you try and think through the broader public health impact of something like this.
Yeah. So I've been thinking about both the acute impact of for 1 month not having enough money for food, and then the long-term impact on those families. We know that when families are not able to purchase enough food, first of all, they rely on lower quality, less healthy items, right? So their health is going to take a hit. We actually see that when people run out of SNAP benefits at the end of the month, hospitalizations increase for example, for people with diabetes. So we know this has acute, immediate impacts on health. We also know that when children are hungry and they show up at school, it's hard to concentrate, it's hard to learn. And that not only affects those children, but it affects all the children around them in the classroom, right? And then as the month goes by, families are going to need to make tougher and tougher decisions about how they're going to spend their money. Obviously, you need food to live. So that means maybe rent doesn't get paid, or car repairs don't happen, or your cell phone gets turned off. And then that has really long-term effects on these families. We may end up seeing more families experience eviction. We may end up seeing more families unemployed. So this is more than just a 1 month short-term impact. This can change the economic health of families for months and potentially years to come.
Are there are there options, Kate? Are there sort of alternatives that can step in and fill in the gap if this were to happen, meaning states or charities or churches?
Yeah. So there have been reports of some states trying to cover the gap. The thing is that SNAP is a massive program, right? $100 billion are spent by the federal government on SNAP every year. And so there's no way, first of all, there's no way that states can cover this gap. And there's no way fully for the charitable food system to cover this gap. Our food banks and pantries are working double time, triple time to try to be prepared for the families coming in. They're already seeing more and more families coming in looking for food out of this fear of what's going to happen in November. And they are doing the best they can. But the charitable food system in this country is not set up to make up for the loss of SNAP benefits. Really, SNAP is our largest food assistance program, and it's our best program for addressing food insecurity and reducing poverty in our families.
Kate, important topic. Thanks so much for helping us think through it.
Thank you.
That is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wealth.